Bill Ackman lost approximately $4 billion on the Valeant Pharmaceuticals trade between 2015 and 2017, making it the largest single-position loss in the history of activist hedge fund investing. But the Valeant trade did not merely destroy hedge fund capital. It destroyed the healthcare real estate, the pharmacies, the distribution centers, the specialty drug retail infrastructure, whose valuations had been built on the assumption that Valeant's price-gouging pharmaceutical model would generate permanent revenue streams from the properties those drugs moved through. That is the forensic entry point this episode takes. Not the trade itself, which has been extensively documented, but the physical real estate ecosystem that the Valeant model created, inflated, and then destroyed when the model collapsed under regulatory and political pressure in 2015 and 2016. Valeant's strategy was specific: acquire pharmaceutical companies, eliminate their research and development operations, and aggressively raise prices on the acquired drugs to extract maximum short-term revenue from the existing product portfolio. The strategy generated extraordinary revenue growth between 2010 and 2015. It generated a network of pharmacy and specialty drug distribution relationships whose physical real estate was built around the revenue projections that the price-gouging model had produced. And it collapsed with specific speed when the political and regulatory environment that had tolerated the model decided it would tolerate it no longer. The real estate does not collapse at the same speed as the pharmaceutical pricing model. The buildings that were built, leased and financed on the basis of the Valeant revenue projections remained standing after the revenue projections were revised downward by 60 and 70%. The landlords whose lease income had been underwritten against Valeant-dependent tenants found themselves holding long-term leases against tenants whose businesses had been structured around a pharmaceutical model that no longer existed. This is the specific mechanism this episode examines: the transmission from a financial model's collapse to the physical real estate that had been financed around that model's assumed permanence. Subscribe now, because the Valeant case documents a real estate failure mechanism that this channel has not previously examined at this scale. The pharmaceutical supply chain as a real estate anchor whose removal left the physical infrastructure behind. Valeant Pharmaceuticals International's business model between 2010 and 2015 was built around a specific relationship with specialty pharmacies whose physical infrastructure, the buildings, the dispensing equipment, the cold storage, the last-mile delivery networks, was calibrated to the revenue volumes that Valeant's price-inflated drug portfolio generated. The most significant of those specialty pharmacy relationships was with Philidor RX Services, a specialty pharmacy network that Valeant had secretly funded and controlled while publicly presenting Philidor as an independent distribution partner. Philidor's operations, approximately 30 specialty pharmacies in multiple states, had been built around the specific drug volumes and pricing that Valeant's portfolio generated, making Philidor's physical real estate footprint almost entirely dependent on the continuation of the Valeant distribution model. When the Valeant-Philidor relationship was publicly disclosed in October 2015, triggering immediate regulatory scrutiny and investor alarm, the financial model that had justified Philidor's physical infrastructure collapsed. The pharmacies that had been built, leased and staffed around Valeant's drug volumes had no comparable alternative revenue source available at the speed the model's collapse required. The specific real estate damage from the Philidor network's collapse was concentrated in the pharmacy, retail and specialty distribution categories, buildings whose lease terms, equipment investments and operating infrastructure had been calibrated to revenue projections that the Valeant relationship had provided. When those revenue projections disappeared, the buildings did not disappear with them. The leases remained, the equipment remained. The employees who had been hired to service the Valeant volume remained, at least until they were laid off. This is the specific financial transmission mechanism that activist capital's destruction of an operating business produces for commercial real estate. The business's revenue contracts. Suddenly, the physical infrastructure remains, and the landlords whose lease income was underwritten against the business's revenue projections find themselves in the same position as every hotel lender this channel has documented, discovering that the RevPAR trajectory they underwrote does not match the RevPAR trajectory the market produced. The mechanism is identical. The asset class is different. Bill Ackman's Pershing Square Capital Management had accumulated a position in Valeant Pharmaceuticals that reached approximately 9% of Valeant's outstanding shares, representing an investment of approximately $3.3 billion at its peak, in a trade that Ackman had publicly characterized as a long-term investment in a pharmaceutical company with a superior capital allocation model and a management team, Mike Pearson's leadership team, whose strategic discipline in eliminating R&D expense and focusing on acquisition and price increase had generated compound returns that the broader pharmaceutical industry's R&D intensive model could not match. The institutional denial embedded in Ackman's Valeant thesis shared the structural characteristic this channel has documented across its archive: the treatment of a specific financial model's recent performance as evidence of its permanent validity rather than as evidence of its exposure to the political and regulatory environment, whose tolerance was the necessary condition for its continuation. Valeant's price-gouging model required the continued political and regulatory tolerance of drug price increases that were, in many cases, measured in multiples of hundreds of % on drugs whose clinical necessity made substitution difficult. The 2015 congressional scrutiny of drug pricing, personified by the Turing Pharmaceuticals Daraprim price increase that made Martin Shkreli a household name, and by the subsequent focus on Valeant's own pricing practices, eliminated the regulatory tolerance that the Valeant model's profitability required. Ackman's thesis had not adequately priced the political risk of a model that depended on regulatory inaction in an environment whose political dynamics were increasingly hostile to the behavior the model was monetizing. The real estate that had been financed around the Valeant model had not adequately priced the same risk. The specialty pharmacy leases were long-term. The political risk was not priced into the lease terms because lease terms do not typically incorporate political risk assessments for the tenant's underlying business model. When the political risk materialized, the lease terms remained, and the landlords discovered that their long-term leases against Valeant-dependent tenants had been written without the protection that a pharmaceutical model's regulatory exposure warranted. The specific real estate damage from the Valeant collapse extended beyond the Philidor pharmacy network to the broader healthcare real estate ecosystem that had inflated in response to Valeant's growth trajectory. Healthcare REITs and healthcare real estate investors had capitalized on Valeant's revenue growth by developing, acquiring, and financing properties whose tenants were directly or indirectly dependent on Valeant's drug distribution volumes. Medical office buildings near the specialty pharmacies that distributed Valeant drugs, the logistics and cold storage facilities that moved Valeant's temperature-sensitive products, and the retail pharmacy locations that had built their dispensing volumes around Valeant's high-margin specialty drugs, all experienced demand contractions when the Valeant model contracted. The magnitude of the real estate impact was not equivalent to the magnitude of the investment loss. Ackman's $4 billion loss was concentrated and immediate. The real estate impact was distributed across multiple property types, multiple geographies, and multiple tenant relationships, making it less visible in any single transaction while being genuinely significant in aggregate. What the Valeant case reveals in the context of this channel's 95-case archive is a specific category of real estate failure that activist capital's destruction of an operating company produces. The physical infrastructure that was built around the company's financial model remains after the model collapses, financed by landlords and lenders whose underwriting had treated the business's revenue trajectory as a permanent feature of the real estate's cash flow generation capacity. The pharmaceutical supply chain is not conventionally considered real estate infrastructure. In the Valeant case, it functioned as real estate infrastructure, as an anchor tenant whose presence justified construction, financing, and lease rates that the anchor's removal made unsupportable. The $4 billion loss is documented in Ackman's investor letters. The real estate it destroyed is documented in the vacancy reports of specialty pharmacy and healthcare logistics facilities across the states where the Philidor network operated. Both are real. Only one made the financial press. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication.